Okay, so let me welcome all of you. Thank you so much for coming. My name is Kesia Rast, and I'm the Executive Director of the Center for Affordable Housing Finance in Africa. I'm here with my colleagues, Nasipi, who drives our communications program, Tandiwe, who's the head of the AUHF Secretariat, and Beatrice, who is our research manager based in East Africa in Nairobi. And Beatrice, in fact, will be taking over the moderation once we start. So we're here and we're very delighted to welcome for the third time now Bezant Chongo, the CEO of Symbiotics Capacity Building. Bezant and I have been working together for a very long time in housing microfinance. And for those of you who have been working in the field, you would definitely have come across one another. So I'm sure there's many friends in the room. Stephen Wanjala is the founder and executive director for the Housing and Development Finance Consultants Africa. I think everybody knows Stephen. He is a prolific writer and commentator, and a passionate advocate of housing microfinance. We all of us have been together since at least 2008 working in this field, which says a little bit about how old we are, but perhaps maybe also how much we have to share. So for those who are new to this webinar series, there were two previous editions, and that material is available on the AUHF's website. And this third edition is looking at sustainable portfolio growth, which is literally the key word, something so important, especially as we seek to add capital into this market, which Bezant, I know, is something that you're focusing on quite seriously with the microbuild fund as well. So with no more distractions, let me hand over to the two of you. Thank you so much for doing this, and I look forward to the presentation, the discussion afterwards, and very much so the discussion that carries on after the webinar series. For those who haven't yet joined our AUHF Academy, this is part of a wider effort that the AUHF is making to support capacity building and training and peer exchange across practitioners in housing in Africa. So if you don't know about it, please be in contact and we'll send you all the information. It's a really nice initiative. Doesn't cost anything. And if you have something to share, we'd like to know about that too. So, Bezant, Stephen, over to the two of you. All the best. Thanks so much.
Thank you, Keisha. It's a pleasure to have this opportunity to share with you, exchange our experience in the field of housing microfinance. And it's very much been a two-way street. The engagement, the question and answers have been very fulfilling and also informative I speak for Stephen, Keisha, and the rest of our team here. So for today, for a start, I just want to take a few minutes to recap what we've covered in the last two webinars. And then I'll be handing over to Stephen, who's going to focus on today's topic, which really talks about how do we sustainably scale. Beatrice, if you could just put up the slides. Thank you. And if you could just run the presentation and move us to the second and third slide. Thank you. So with regards to today, when we look at what it is that we're going to focus on in terms of scaling, we're going to look at an evidence-based approach. What does make for success in terms of scaling housing microfinance? What are the key ingredients, 6 capabilities that an institution would need to have in place? Experiencing from the pilot, and the pilot where we're talking about having a proof of concept of, say, potentially being able to actually roll out 500 loans, quite a different context to when you scale your portfolio to 20,000 loans or clients. So we'll be looking at what it is that drives from a successful pilot and then being able to grow a housing microfinance portfolio. That's the focus for today's webinar. As I did mention in our first webinar 2 months back, we really looked at housing microfinance 101, especially in the African context. Why housing microfinance exists, what gap it's filling, and also really defining housing microfinance in the context of differentiating it, say, from the mortgage market or the microfinance market. Then last month, in the second webinar, we went into a bit of the ingredients for actually what makes for a housing microfinance product and offering. What are the minimum capacities that an institution should have in place for a successful housing microfinance rollout? And preempting that with a pilot, that before rolling out, you really would want to design a product from a bottom up, understanding your client's needs, your market needs, having a product, and then driving that with a pilot. So today, the premise is you've had a pilot. How do you measure what a successful pilot looks like? And from that, then how do you then begin to scale your portfolio to actually have a viable business case, a product that becomes part of an institution's offering? So with that background, I will hand over to Stephen, who's going to drive our discussion for today. And we do intend to leave some time, some 20 minutes at least at the very end, to hear from you in terms of those of you who have actually had the opportunity to delve into housing microfinance. What has been the success elements or the challenges, and in the backdrop of what we would have shared over the last 3 months or so. Stephen, over to you.
Thank you, Bezant, for that. So today's today's agenda, we are going to look at essentially moving from readiness now to scale, where we will see readiness is just the starting point, but it's not the destination. And why are we saying so? We'll dive deep into that. Then we also look at how the pilot ready is it for scale, because the pilot we were testing out, and how is it ready for scale, because it's not good enough just to do the pilot and just say, oh, the product, the clients like it. You must also be ready for taking to scale. What does scale then incorporate? Then what changes that an institution need to take into cognizance when it starts thinking about scale? Because as you are all aware, housing microfinance has been around for the last almost 20 years across Africa, but they are very minimal scale. But most institutions have done pilot, and they have remained in pilot forever. What are some of the changes that institutions need to take cognizance of if they must be ready to take it to scale? Then we'll also look at building the foundations for scale. What do you must work on to be ready to take on scale? It will not just happen. Then what is the preparation that you must prepare for scaling the growth? Then looking forward, then lastly, we'll look at a discussion, question and answer from the team. Next. So as you can see on that photo is a loans officer undertaking appraisal, just to give a context on that. So it's basically building on the foundations of the last webinar 2, which was institutional readiness. So we are building on that. So these are just building blocks. Next. So looking at starting from institutional readiness, as I've said, is the starting point, but it's not the destination. So looking at what are the conditions that should be in place to be ready for scale, and hence scale for that matter. So we've had the institution is ready. It has the product, it has the policy, it has the staff, and the risk foundations are all in place. Then the institution moves to a successful pilot. After the pilot, the next stage is evidence that there is demand, the performance is right, there's viability, there's a proof of concept. Then the next step is institutional commitment. You can find the institution, there's evidence, the demand is there, but when it comes to the institutional priorities and commitment, you find it's also a strategic priority that must also feature within the institutional strategic plan. When you have an institution that doesn't have strategic plans per product, that is where new initiatives get lost somewhere in between. Then fifthly, we'll be looking at the sustainable scale. What is the business now? The institution is agreeing that this is a business that we want to promote. So making it a business case within the institution and also allocating resources. So looking at, is the pilot really ready for scale? As you can see the photo there, this is a client that was given barely under $1,000. This is the final product that she has. So there is a story when we get into housing microfinance is where now this comes in and works with the client who has started the journey. And this is now what we want now to take to scale, like for this particular client. What should an institution take into place as it plans to scale housing microfinance? One of the aspects that the question that we should be asking ourselves, has the pilot worked? But the question that we should be asking, there are various aspects that we must be looking at, not just looking at there's excitement from the clients you have talked to. So we start from looking at the client. Is the product consistent with the target group that the institution is working with? Is the product serving the intended purposes for the clients? How are the repayment patterns from the client's perspective? That is one aspect from the end user. The other aspect that we must also look at is the operational, looking at how are branches, because when you start a pilot, you start in a few branches. Now you've scaled the product across your whole network. How has been the branches been consistent in delivering the product around all the branches? Because it calls for a lot of aspects that and a lot of learning within an institution. How are the turnarounds? Because the turnaround will give on how systems are working or not working. Can the system that the institution has, it has done only 500 loan or 200 loan, and that is the most of the numbers that most institutions do at pilot testing. So how do you move from 500 loans within 8 months or 6 months to move to 20,000 or 10,000 loans a month, which some of the institutions are currently doing? It calls for looking at how operations are ready to take on scale. And that is an aspect that is never talked through. We just look at, we have done the pilot in success, we think we are going to do 5,000 loans a month or 6,000. It doesn't just happen like on and off. There are aspects that must be planned for. Looking at the financial aspect, does the product remain commercially viable? Is the quality of also the product doing well? And in most cases, institutions that have gone into housing microfinance, the product has been better performing than even business loan because there's sentimental attachment to the product as from the client's front. What are the institutional funding requirements? Because if you did 500 loans and you want to do 5,000 loans or 10,000 loans, you must have also thought about the funding requirements that will support that scale, which must also have been already been thought through. Then at the strategic level, how does the housing microfinance fit within the institutional strategic plan? Is it at 10%, 20%? And this is an aspect that is always left out, that institutions don't plan product-wise and seeing what percentage of the overall portfolio do we want to have this product to sit. If we don't become intentional saying 5% or 20% in 3 years or 4 years, you will find any new initiative just falls through the cracks. So it's very, very important that institution and the management and the board must also be committed at that strategic level to take on that scale that we are talking about. So it's a strategic decision that will respond to the scale that we are all looking at. Then what are the changes that an institution needs to see? As you can see the photo on the right, that is, those are farmers in one part of Uganda. These are tomato farmers that every month they contribute to one of their farmers to build the house. So you can see what transformation, when there is a structured, can lead to changing a whole community. And looking at those houses, you think it is in an urban center, but that is a rural setup. So there is housing demand, whether urban or rural, the need cuts across. So scaling affects essentially the institutional setup, how an institution has been previously been operating. So looking at scaling that cuts across from the institution fabric, all aspects, looking from pilot stage to the business line. Looking at when the institution was doing a pilot, it was limited branches. Now it has spread out from 5 branches, maybe to 50 branches. That brings a lot of dynamics that should have been thought through. Dedicated product team, you find when they get into business, making it a business line, it is all integrated and is every person's responsibility to drive the business. Testing, now we have tested to see how things are working. But when you go to scale, you are still learning and you are still improving. One of the mistakes that most institutions do when they do the scale up or rollout, they think that is they get into autopilot, but that is still another problem of managing scale and continuous improvement. Internally, you'll always find that a pilot, you require some external support to get some new initiative. But when it comes to a business line, you'll find there must be internal ownership. There must be demand being driven from internal management and board level. So other than external support that supported you from the pilot, now you are coming to an aspect whereby the internal ownership of driving this business becomes very critical. Pilot is always short term. When you get to making it a business line, you are looking at long trajectory in long-term commitment, looking at 5 years, 10 years, how will things look like? So you are moving from short-term focus to long-term commitment, and it comes up with other ways that you should be looking at business. Where does growth bind first? Looking at MIS and reporting is an aspect that most institutions, if you cannot quantify what you're doing, it becomes very difficult to have information that you will have to present to management, to the board, and also to external funders who will want to take your product to scale. Then the branch execution. How is the branch support, systems, staff capacity? Those are always very critical aspects. And knowing that housing is different from enterprise, but housing is anchored on livelihoods. So when an institution is not doing well on their enterprise development, they always have challenges when they move into housing microfinance, because it's the enterprise that will support the housing loan repayment. So these two, it's always like now, you must look at these two aspects. But when you have one is struggling, it will have an impact on the new initiatives. And that's why I always tell institutions, they have always to ensure that their current business is doing well before they move into new initiatives, because new initiatives will require a lot of resources, a lot of close monitoring, and more time dedication to get things right. Then also, binds also as volumes also start building up, you'll find also risk can also start growing, as also portfolio management, all those intricacies start coming in. The whole issue of treasury and funding, where am I going to get money? Because most institutions when they have started their housing product, because they didn't plan for scale, then they find that they're having so much demand that with their treasury and their funding becomes constrained. So, and this is a product that has always overtaken other products that institutions has started before. So it's a product that is very sentimental to clients. Any institution that has started has always overtaken other products that the institution has. Because, and currently the business loans that the institutions are giving, essentially research has shown 20 to 30% of the business loan are getting into housing. So when there's a more structured product, there's always tendencies for clients now coming for more of a structured product for housing. Then operations also have always to be looked at, and looking at for scale, what are the implications? How we were doing 1,000 loan, now we want to do 10,000 loan to get more funding. How are our operations ready to take on scale? Because scale comes up with also implications that will impact on a very good product, that you'll find the product's not doing well because you didn't think about the impact on your current operations, how they are. Then when you look at the institutional level, one of the key aspects is governance. And it's always important that product budgeting, which is always a challenge within most institutions, product budgeting, product monitoring, and product pricing. Those becomes very key aspects that guides management and the board to make sound decisions. It's all about data and tracking product-wise. That when you have just that most institutions, you'll always find they track values other than products. And that's why when they get into starting new initiatives, they suffer because the institution has not had a practice of monitoring product-wise, other than monitoring value. That a loans officer is supposed to do 200,000 loans a month. And when you find that their menu, they have 6 or 7 products. So you find the staff also have no interest in promoting the new product because the institution has no practice of tracking products. So when you start new initiatives, they get mixed up in the whole mix. Then leadership priority. When also management doesn't acknowledge that overall portfolio, we have 20% housing, 10% agriculture, that segment, it leads to management never being focused and driving a new initiative that requires more monitoring, more support for as it gets to scale. So it builds on what are the practices that exist in an institution at the moment. That's why we do institutional assessment to see how is the institution doing its current business. As you bring in new business, how is it going to impact on the current practice that exists within that institution? Then the customer experience. What are clients take on the product? How is the impact? How are the clients looking at the product? How is the impact as you go out? And also tracking any money that you are giving an institution that has no interest what the money is doing. Also, it will have an impact on the clients also not seeing an institution that is not caring that I gave you money to do a house. Can I see your house that you did? That monitoring bit and showing that you are caring makes a client also perform well because you are also a caring institution. You are also following through what the impact of the money that you gave has done. Next. So the other aspect is when we have housing competing for internal priorities, this is now what also you'll find most of the time. It's not that the demand is not there for housing, but what are the internal priorities within an institution? And this will also lead to where the institution puts focus. So when an institution has not intentionally highlighted what portion does the housing tech, enterprise, agriculture, and all the other digital loans, what percentage they're taking of the overall portfolio, you'll find it has an impact. And one of the aspects is the loans officer incentives. When the incentives are not product-wise, but they are only on value, you'll find new initiatives suffer. The same thing applies to branch management and branch managers. If they are also not having targets and focus product-wise, new initiatives have always fallen off the radar. Not that because there's no demand, but the systems can't support focus for management, from the loans officer, from the branch management, from the senior management up to the board level. Also, the other aspect is treasury. Looking at most institutions that are doing enterprise development, you'll find most of the loan tenures is 6 months to 1 year. That when it gets now to housing, you'll find it will require a bit longer tenure. And looking at institutions, will see they'll make more money by short tenures. So you find there's a conflict there, that institutions will then resort back to the default setting of short term because they'll still make their money. Why go for long term? So it requires strategic decision that influences how Treasury should look at a business, how the management should look at the business, how the board also look at. It makes every person aligned that this is the business that you are doing is different from enterprise, will require longer tenure, and let also Treasury know that, but not only looking at what is the bottom line, how much, where are we making money? We'll make more money than the forecast. Then also that implies that the officers will also not be bothered about that product. But you go out, the demand is there, but the system and the institution is not, the DNA is not right to drive the business as required from the end users. Then competing on the MIS, requiring how the MIS is set, how it's being tracked, looking at how the whole system, how the repeat clients are coming, what are they doing. That also gives a motivation, the management to also to see it's important to, because there is impact, they can see what they're funding, and that gives more credibility, and the loan performance is okay, the staff are also happy, so everybody is happy at the end of the day. And it all comes from the type of the MIS we have put in place that will support the product that is different from what we have been having for enterprise loans. Then the credit committee. Institutions, you'll always find the credit committee, they'll always want to go for an easy. But when this one only comes when there's a good understanding and an institution is also has made a strategic decision that housing has to be 20%. Every time you give any money, know that there's 20% or 30% that should be in housing. Then you'll find the credit committee, everybody is aligned. So when you have set the target right, it aligns everybody, and it all comes from the tone, from the high level, and that is at the board level and the strategy level. Then also management attention, when it has been approved and the board has also consented to that, management has no option but also to ensure that they give it the attention, it is tracked, and the board is also getting reports that everything is aligned as to what they approved at the beginning. Next. Then what are the foundations for building sustainable growth? And this is the aspect of training and capacity building. Because every product has its own intricacies, and staff must be well prepared that when you find an institution say the alone is alone, then you find there is a challenge there. That when you start a new initiative, it's going to suffer. And it will be not that the product is not right, but the institutional DNA has not been aligned. And hence, knowing that the enterprise loan is different from the housing loan, and that is what should be done at the training level. And this starts from the leadership at the strategy level, operational level, risk, technology, people or capacity, and the regulatory framework that under which they are operating. And you'll find that at the institutional level, where the board has to take this as a strategic product that is within their strategic plan and which they are also tracking at their particular level. Looking at the processes, operations, how are the branch operations, regional operations, how are all aligned that you can track product-wise, not value. And the challenge has been, mostly it has been about values, not products, and hence that's why the housing and new initiatives within institution, you'll find an institution has 6 products, 7 products, but when you talk to staff, they only know over 1 or 2 products at most. Then if you are starting a new initiative like for housing, know that it will also fall to be a victim. Then the portfolio concentration. This is what I've talked about earlier. We have to be intentional. If it's 20%, 10% of the portfolio, let it be made very clear so that the institution is also tries to diversify its risk, to have a diversification of its product, and also responding to what the client's needs are. So this also becomes very key at the scale level, that it has to be agreed what percentage are we having the concentration for housing and other products, and there has to be a reason why. And this is why now the understanding promotes the understanding, and hence having things at the strategic level. Then at the dashboard and analysis, how do we analyze product-wise? Is it the outreach, value, performance, impact, all those matrices that we need to be tracking, and the indicators must be very clear for different products. But if we have generic matrices that cuts across just credit is credit, we miss initiatives like housing, agriculture, because all products are unique in their own way. So the dashboard should be clearly able to show that there's a difference. But when we only track its value is $1 million, that is it. You don't show the differentiation. That also impacts on how also staff view the new initiative that you want to take it to scale. Then the institutional competencies, right at branch level, regional level, management level, board level. That whole understanding is very, very important, that every person, they are all speaking the same language and speaking from the same script. And also the prudential regulations and guidelines. Institutions that are regulated, and there's always an issue that when an institution thinks about going into housing, most of the regulators have always seen this is long-term, and hence require security, titles, and then that waters down the whole product. As you will see, housing microfinance is not long-term. There's an average of 2 to 3 years max, but you'll always find, because clients want to move to the next phase, and the next phase, they come for short-term. So it shouldn't be a limiting factor, but the institution must be understanding well what housing microfinance is, and they are able to explain to the regulators the difference. Not when they talk about housing, somebody thinks about a mortgage. Then they require how is the loan secured. Then it throws the whole discussion out of context. So it's important that an institution to have an understanding of what the business they're promoting, and even when the regulators come, they are able to explain and defend what their business is, because this is a new initiative. Also, the regulators are still yet to come to terms. So the institutions that are practicing must be well versed to be able also to enlighten the regulators on that front. So any institution that you move from 500 loans to 20,000, it comes out with a multiple aspects that you must take cognizance of as you think of getting to scale, because it's only scale that will make you sustainable. So looking at the regulatory parameters that bind at scale, it's always the whole issue of unsecured loans, exposure limits. You must take cognizance of that. What does your regulator require, so that you are also playing within that parameter. The tenure restrictions is always very important to know that housing might go for a bit longer term. If your loans, your average loans are always 6 months, know that for housing, it might stretch for 1 year. How will that turn out to be and sit within your general practice? So it also comes for a lot of education within internally, and appreciation of the new intricacies of the new venture that they are moving into. Also looking at the provisional treatment. How do you classify short-term lending and also looking at housing? So all that comes into context, and the provisioning comes also when the understanding of the different intricacies of the product menu that you have and you are offering. So, and also the capital adequacy, that looking at the exposure, that you'll always find that one will say that housing might be long-term, will be take long tenure, and hence let's concentrate on short-term for secured lending as volumes rise. So it requires a lot of thinking through, and it only comes very clear when these aspects, when the whole institutional staff, whether they're in finance, they're in treasury, understand the intricacies of the product that they are promoting. Then the other aspect is on single product concentration. You will find that most institutions have always what is called the star product, that you'll always find this is the product that makes them more money, and there's always a tendency for always leaning towards that. And you find that new initiatives suffer because of that. And also, another aspect is supervisory reporting is very, very, very key, because every reporting of every product requires different parameters that you will need to track. How your MIS can be able to adopt that becomes very critical ahead of growth. So how do then prepare for sustainable growth? Because growth will not just come. We must look at the funding that is going to grow that loan book that we are looking forward having. So it all comes from capital, liquidity, and how we are going to fund the growth that we are looking at doing, the 20,000 loans and more that we are hoping to do. So one is the 10-year mismatch. Looking at if an institution, its funding is always for short term, when it gets into housing, it calls for discussion from their funders or their partners that they're having to have that understanding, so that you don't have your loans, you are structuring them for 2 years while the funding stream that you have is for 1 year. It will cause a mismatch. So it's important to have that understanding, and it also comes at ground when you are discussing with your funders of how you have structured your product and how you want their funding that's coming from them, how should match what your product is, so that you don't have that mismatch. So then the other aspect is the liquidity pressure that you'll find if loans are going to be longer than the business loan, which is 6 months, then you have to see how you balance and you concentrate your portfolio so that you don't have that liquidity pressure. And you also look at the funders that you will be looking for that can promote your business. So it calls for a whole understanding from all angles. And this one can only happen when there's that understanding from for knowledge perspective, and also convincing the funders that you have so that you don't have that liquidity pressure. Then looking at the capital consumption, that when we are looking at the exposures of unsecured, that has always to be tracked very, very carefully so that you don't mess up your capital being depleted so fast. It's always important you look at those exposure limits that you want to have based on the funding structures that you have, and your treasury have to take cognizance of that. Then the foreign exposure limits is always very key, where how you are getting your funding, if you are getting it from local currency or hard currency, and how looking at the credit risk. All those aspects must be looked at as you venture, because we are wanting to get scale. You'll have to get local funders, you have to get external funders, and all these must be looked at very keenly with your treasury unit. Then the fund diversification is important from the various sources. If you are a deposit-taking institution, you are an institution, maybe it's a credit only, you are getting from a wholesaler credit lines or DFIs that are giving you. All these facilities come at different tenures, and it's important to understand those different tenures and on the product that you have had that is coming longer tenure than what your business loans that you have been having previously. So all these aspects requires to be thought through and look at where you strike a balance. Then pricing for sustainability. Every product must have a loan process, and from the loan process is when now you can identify how the product should be priced. And in most cases, from the market research we have always been doing with institutions, clients will always want the housing loan to be cheaper than the business loan because it's going to be non-productive. So they will always want to be at a lower price. But then how does an institution come up with a comfort that they can give at a lower rate? They must also have a good pricing structure, or which understands the loan journey or the loan process that an institution goes through to issue a particular loan. So that guides on how the pricing will be done, not compromising on the product or the service that they want to offer to their client at the end of the day, not focusing on what the competitor is offering. Because a new product, the competitor is offering a 16%, me, I will offer that. No. And that is what most institutions, because they don't have a very clear product pricing method, which they go by what the market is offering. But the other institution may be having a different processes of how, and their cost structure is different. So it becomes very, very important to understand yourself. How do you price? What are your cost centers that will guide you on arriving at the right pricing at the end of the day? Next. Then looking at the key aspects that institutions must be ready for having a larger portfolio, because if you have had a small portfolio, it's not on and off just to manage a big portfolio overnight. It requires confidence that the growth that you are going into will be sustained at the end of the day. And what does that call for? You have adequate liquidity that will support that. You are having your provisioning practices that are robust, that understands the portfolio seasons. The staff are well trained, have the competency, the management have the right competencies ready for volume. Because that is an aspect that we never take cognizance of. It's just they've been doing credit. They'll just do scale, no problem. Then that is where disaster strikes. Then are the systems able to take on scale and reporting this new product that you must report closely, because it's a new product, you must have a very robust system to keep things on check. So as I end there are some questions that are open for discussion. That what does really growth typically bind fast in your institution? Which funding structures best fit for a housing portfolio? How is housing performance evidenced and monitored internally? Then what assurance or evidence will your board require to support growth? Because that is always the biggest hurdle that institutions go through to get products approved of the board. I open the floor. Just a reflection of those open questions. Or it was too much to digest.
Maybe while waiting for some of the reflections from the participants, there were one or two questions, if we could just maybe address those. David raised the question, Stephen, as you are presenting, in terms of, when you make the switch from pilot to scaling, then there will be conflicting priorities and resource allocation to scale up the housing microfinance product, even after a successful pilot. So, David, you asked from our experience, what does make a difference? What are some of the lessons? And if I can just share one or two perspectives, and then Stephen can come in. One of them, which was part of what Stephen indicated, when you are launching the new product and pilot, you want to have sponsorship at the highest level in the organization. For a pilot, for instance, it might be a senior executive member, but by the time you're deciding to scale the product after a successful product, you want buy-in and strategic alignment at the highest level. So sponsorship really at as high as a board level, where you could have a product champion who believes in the housing microfinance product. But how do you get such buy-in? Again, this is also based on, yes, you could have a successful proof of concept pilot. So the product has got capacity for uptake. There's demand. But does it also make a viable business case for the institution? So the numbers should make sense for the institution, for resources to be allocated, for treasury to allocate resources, for HR to be allocated to scale up the product. There should be a clear business case behind the product. So this then begins to reduce some of the challenges or the resource allocation issues that might arise. So first, buy-in. How do you receive that buy-in on the product? The product should have a clear business case. It should make financial sense. Then after that, to really move from a successful pilot to scaling, you would want to ensure that the actual resources that are allocated to ensure that the product is not going to fail, not for lack of the design of the product or not having demand, but because sufficient resources have not been allocated to it. But those resource allocations will only make sense if the numbers make sense. Hence, then you would be able to have the right sponsorship and buy-in, and that will ensure that then the product is well integrated and aligned into strategy for the organization. For some of the institutions that we've worked with in the last year or two, institutions that we worked with in Kenya, institutions that we're working with in Uganda, this issue of ensuring that there is resource allocation, even at the time of launching the pilot. If we are supporting such an institution, whether it's through technical assistance, we also want to have visibility that the institution has got a plan, for instance, for financing of the product, that there's capital that has already been identified or is in the pipeline to ensure that when you move from pilot to scaling up, there's sufficient resources allocated towards the launch or the rollout of a housing microfinance product.
Just to add on what Bezant has highlighted, one of the aspects that, based on my experience, I've always, the product champion must be a very strategic person within the institution, that a person who also sees the value. Somebody, whether it can be high and in the institutional level, but if it doesn't buy in from the product, from the word conceptual level, is always a problem. So that alignment and also getting the senior management to understand what are the qualities of who the product champion should be. That is what we provide guidance that also guides an institution, because that person is very key to the success or no success of the product.
Another question from Titus. How have the institutions who've ventured into housing microfinance marketed the product? One way in which you take a housing microfinance product to market is you would want to, first of all, it depends on, are you targeting a new market segment, or are you introducing the housing microfinance product to an existing client base? So if it's an existing client base, you would typically really use your existing marketing channels that you use, whether it's for MSME products, that's what you're going to use. If you're trying to target a new market segment, you would probably look at partnerships. In our first and second webinar, we did say that one of the success routes for introducing housing microfinance is to look at strategic partnerships, especially with building suppliers. So going into partnerships with material suppliers, building suppliers is another way of taking a housing microfinance product to market, especially if you're trying to tap into a new market segment of clients who are not necessarily part of your client base. So the route to market to a great extent will depend on who the market segment is, and also so in terms of your product design, is it one which is generic, or you're looking at financing a very specific component of the housing construction value chain? Titus, I hope that answers your question.
Yeah, and most institutions will always just, because one of the aspects that we always guide institution, let a new product not divert them from their normal practice. If something is deviated from what they practice, there's always a bit of resistance. So they'll continue with what has worked best for them. And you'll find most of the institutions that are getting into housing, these are already existing institutions for the institution. So it comes as an incentive product that the clients who have performed well, they are the ones who can access this because they have a good track record. That they have no problem giving them a longer tenure because they have a good record with. So it comes with looking from different aspects that gives comfort to an institution and leveraging on what they have been doing before, not trying to start new different things, because there's always resistance for new things.
And maybe while waiting for reflections from participants also, there was a question quite early, I think it was from Lusanda from TAF. You asked about experiences or institutions that have or are involved in housing microfinance in the South African market. So the South African housing microfinance market has had mixed experiences. And also it depends to a great extent whether we're going to take a very broad definition of housing microfinance as part of a spectrum of affordable housing, in which case one would say that TAF is also a player in that market. Otherwise, one case study that comes up significantly in literature when we talk of housing microfinance in South Africa, and I can talk with confidence because I worked with this institution a couple of years back. There was the Kuyasa Fund, which was based in Cape Town but had operations across Western Cape, Eastern Cape, and their model was very much around supporting RDP house beneficiaries, using that as a basic unit, then providing incremental loans to scale up, to upgrade the housing. The Kuyasa Fund, to the best of my knowledge, currently is not in operation, but it was a model that really fits the South African context because of the existence of a captive market with RDP house beneficiaries. Other institutions that come to mind, there's an institution called Indlu Finance, that's INDLU. Their work was not on my radar until quite recently because they partnered with the Rand Merchant Bank, who are actually providing them with a facility of about 1 billion rand in blended financing for them to grow their housing microfinance portfolio. So there are different pockets of excellence, if you could say that, though they might be quite niche and ring-fenced. But there are quite a number of initiatives over the years that have gone into the housing microfinance market. Another one that comes to mind is what was Tutokani Financial Services. They were operating out of Pretoria and had a portfolio across quite a number of provinces. They were taken up by Fin Group about 2 years ago, but they maintain their affordable housing portfolio. What is worth mentioning for almost all these cases in the context of housing microfinance in South Africa, that although it's affordable housing servicing the low income market segment, it tends still to be people who have a stable salary income. So in that regard, we are not necessarily expanding the access for especially those who would be informally employed or running their own businesses. So that's a bit of context of the current and historical structure of the housing microfinance market in South Africa. So
I can see Lusanda's
when we reflect,
I see Lusanda's
go ahead.
hand
Sorry,
up.
Stephen.
I can see Lusanda's hand up. Lusanda, can you speak?
Yeah, I can. Thank you very much. Good afternoon to everyone. Thanks for that answer, Bezant. I think my question was really more around incremental home ownership examples, financing someone for home ownership. So most of the ones that I know, I mean, apart from Kuyas, and I'm interested to look at this Tutukani in Pretoria, we weren't aware of anyone who was assisting from that point of view, and we wanted to learn from those examples, if at all, in the country. But ours, and I think Indlu is similar, is microfinance for entrepreneurs who are developing rental stock, for obviously end users who then use those buildings. But we just wanted to know if there are any real examples apart from Kuyasa. We've chatted to them and they have some experiences, mainly in Cape Town, but as you say, they've since closed. So we were really interested to know whether or not there's actually a market in South Africa, if so, where, who has done what, etc. But I agree with you that it appears to be more for salaried people, what Kuyasa at least was doing. And I would be interested to see what is it? Did you say Tutukani in Pretoria, who they target? But yeah,
Yes.
it seems to be a very limited market from what we can see, and we're trying to currently design a product specifically for that market. We know that there are other players in the sort of mining towns through SA Housing Club who finance via employer payrolls. Again, that's salaried people. And whether or
Exactly.
not, of course, there's a market beyond just tying it to employer payrolls. But thanks for that response. That was it's our interest, and we are wanting to explore this further because we're developing this product now. Thanks.
Thanks, Lusanda, and happy to exchange on the side, including maybe putting you in touch with the former team, or at least the head who worked on what was then Totokani and now is part of Fin Housing, to try to get a better understanding of what their model is, if it's closer to the Kuyasa model or more of what you are currently offering. So happy to engage on the sidelines on that.
Great, that would be great. Thanks, Bezant.
Yes, hello, good evening. I go by the name John Kavire. The founder of NCGO. So first, what we are is that we're a platform for growth. Mainly, the first phase is housing. So I'm really happy being part of this program, seeing how housing microfinance can be essential in the development for housing of people. My only challenge is that when we tried approaching some of these banks, but I think they're a bit rigid. Especially, we tried, for example, we tried housing finance, but the system was a bit rigid, and also Pride Bank. So listening to this, it was quite very interesting. I mean, I sat back and I was like, why don't we as NCGO also try and come up with a housing microfinance package that can complement the designs, because first what we do, we design houses that grow literally. So we have I'm a graduate architect, so it's part of my skill of designing growing homes. So each home is phased according to the amount of money someone has. So yeah, so we tried. Many people, of course, the people are happy with the design, with the concept, but many people are still a bit rigid, especially us being a young company. So those are some of the challenges that we are facing right now. But thank you very much for the initiative that I see here. That maybe I, as Joel, should take the initiative of also trying and see how I can look for funding for literally the housing microfinance package itself, because I see that with the right people who have been exposed to the right teachings and the right exposures to people who have been great mentors like Stephen Wanjala, we can see how something like this can be made possible in many parts of Uganda. Because according to our market research, when we did market research, many people are interested in owning a home, and many people mainly asked around. They were asking about the payment packages. That was where most of our conversations were turning towards. And so this is a great initiative. And yeah, anyone who wants to reach out, I'm right here. Thank you.
Thank you, Joel.
And I think I would be remiss to add, Joe, that Stephen is your man. We have an ongoing project in Uganda right now. So I think I would encourage you to exploit Stephen's current initiatives in Uganda to see if maybe there's some complementarity to explore there.
And
Thank you for sharing your initiatives.
so looking at how do we all this series come together and look forward, actualizing as what Joel is anticipating. How do all these series that we started for first series, now we're looking at scale, how do all these come together and looking forward? Next. So looking at the key lessons from the housing microfinance journey, maybe for the people that were not there, we started from the pilot to strategic business case and bringing all this together. The first webinar, we talked about understanding what the client wants, as what Joel is just alluding. So understanding what do the clients want, what do they prefer, then we design a product from the end, starting from end, then working backwards. Then looking at institutional readiness that creates a platform for success, as Joel is saying. There are particular institutions that have an appetite to go in this direction, and most of the candidates that have an appetite for this and they're already financing it, you'll find cooperatives, microfinance institutions. Those are institutions that are working with the segment that is working in the informal sector, and it becomes easier for them to adopt these particular prices and practice and coming up with a product. Then the third series we're looking at from pilot to generate evidence before now we're moving to expansion. Then this third series is looking at what does it require to make the institutional ready? Because if an institution is not ready to raise the issues that Joel is raising, the institution has to be ready, not just looking at growth, but there are those internal aspects that must be aligned to take on that transform. So we are looking at an institution changing on 360 how it does all its business. But in most cases, you will always find it's just a small portion of maybe 10%, then we want to scale, then nothing happens, then we get surprised why things are not evolving. Then also looking at capabilities that must evolve as we also grow. So looking at capabilities is also always an aspect that is always overlooked, that you cannot do scale when you are doing with a scale of 500 and now you want to do 10,000. It requires different capabilities, systems, processes, and also dedicating resources for scale. Then we are also looking at how the objective of how microfinance can be embedded as a business line for an institution. Because if it doesn't become as a business line, we will continue having it on the periphery until it is mainstreamed and is taken as a main business line for an institution. So scaling is not just getting the numbers, but it's all a journey that an institution must be ready, that it must have to transform on how it does its business. Because in most cases, institutions that have done this, like the current institutions, I know Kenya Women Finance, Centenary in Uganda, they're doing an average of not less than 10,000 loans a month. What is 10,000? And as far as I know, I was doing a presentation to the mortgage CEOs of mortgage banks from Nigeria. There's no bank that does almost $15 million in mortgages in Africa. But for institutions like Centenary, Kenya Women Finance, doing $10 million a month, it's no problem. Looking at an average loan size of $1,000 and you are doing 10,000 loans a month, you're already hitting $10 million easily. So it's about scale and it's about volumes. And that's why we are emphasizing it's about scale and numbers. Then it will make a business sense. But if you are doing 200, you'll see it doesn't make sense. But the need is there, the demand is there. So it has to be mainstreamed as a business case and has resources to be allocated to it. It will be taken on by the institution. Then we have open discussions, questions, and suggestions. And these are the questions that we are thinking as we wrap up, unless there's what we want to hear from you, what are some of the key insights or experiences that you would like to share, or topics we should explore in future sessions? I think it will be very important to share your experiences of what is these topics that are important that should be explored in future sessions, because this was just the build-up for more engagements into the future. What questions about housing microfinance emerged during this series that still require deeper discussions or clarifications? I think we'd be more than glad to hear from you. What are some of the more, because you might have had more questions than answers, what are these that has come up that you require deeper discussions or clarifications as we go forward? Are there important experiences or perspectives that we may have missed, or we would like to, you could like to contribute to the whole this conversation? Then the fourth one is seeing how can housing microfinance be effectively integrated in microfinance institutions, cooperatives, banks, to broaden the effort to expand the mortgage or the housing markets in Africa. Then we also welcome your thoughts on your next steps, particularly how you envision how this growing community of practice can support and advance your work. These are the open questions that we thought could kick us into some conversation before we wrap the session. Okay, I can go. There's a question that Belinda from South Africa is asking, that the funding, some of the funding institutions or institutions that has ventured into housing microfinance, what has been mostly the collateral? Most of the collateral, as you are all aware, as you get into housing space, you will find almost 80 or 90% of most of the countries, most of the land is not titled. And what mostly is happening is the aspects that are being used, being that the loans are not that so big. So requiring aspects like title deeds doesn't make value sense. That you'll find most institutions are using sales agreement, certificate of occupants, a household aspect, because you'll find most of the average loan size for most of the housing microfinance is an average of $600, at most $1,000. That doesn't warrant you to charge a title, that the cost of charging that land is more than the loan that the client is requesting. So you'll find most institutions are using alternative forms of collateral for advancing housing microfinance. It's not that because they're doing housing, we ask for titles. Institutions use the alternative forms of collateral, which they have a practice, and what they are currently using, it's not an issue, because the loan sizes are not that huge to warrant any warrant. It's because the average is $600 to $1,000, the average loan size.
If I may also just add that in housing microfinance, just as in when we talk of more traditional microfinance, there is a bit of a continuum that when you're really talking about entry level, and when you talk of shack dwellers here, you even have what is called Shack Dwellers Association, which is more of a network which supports formalization or access to finance for people living in informal settlements. An entry point here is what would be the equivalent of savings group and stokvels. And when those are more structured and formalized, and there's a track record of an existing savings group or stokvel where they initially actually internally borrow on a rotational basis, then there's an opportunity for a formal institution to partner and enter and provide credit more to the group than individuals. Also because the value of the loans tend to be significantly low for an institution to lend on an individual basis. So really for entry level where there's little or no capacity of if any formalization or title, the entry point is where if the people are looking to access to finance can formalize into some form of group like Stokvel Savings Group and establish a track record, then it becomes attractive for a financial institution, which could even be a microfinance institution, then to lend or partner with such established informal groups for the purpose of housing. Okay, So, Stephen, maybe you might want to tackle this, and probably this is a session that we could also look at having a follow-on discussion at some point, looking a bit more detail into the blended finance structures. We could probably be able to do a deep dive into previous funding structures like the microbuild 1 and the microbuild 2, which is currently under development. I think that would probably require its own session. But Stephen, are you able to take up on any of the elements in this current question?
Yes, in regards to how institutions underwrite for informal incomes, and this is where I was saying that an institution that is getting into housing microfinance is leveraging on already an existing practice that you find most of the microfinance institutions on this part of Eastern Africa, Central Africa, where there's not so much of payroll lending, is so much about clients who are self-employed. And institutions are already been working with that segment. So it doesn't raise any eyebrows because they have built systems and processes that can underwrite. But an institution that is getting into this new terrain, it requires a whole package of support to work up with this segment. So the institution must have already competence in working with people already in the informal sector, and they have built systems to underwrite. It's never an issue for institutions that are already working with the people in the informal.
So again, just to say around the latter part of the question, around wanting to know about blended finance structures and how impact investors can support DFIs and support housing microfinance portfolios. So I did refer, for instance, to the microbuild, which was a fund that was promoted, developed by Habitat for Humanity, ran from about 2012 to 2023, 2024, mobilized about $100 million, which was really to provide debt financing into the affordable housing market. The actual underlying funds was from different DFIs. 33 different countries were supported. And on the backdrop of the microbuild fund, Habitat for Humanity is now leading the launch of microbuild 2. The fund manager is Symbiotics, an organization that I'm working with. We're currently in the process of the fundraising and structuring microbuild 2. It's got a target of $300 to $500 million, so a significantly higher scale than microbuild 1. It's very much in the design stage, so I'm not really able to go into the detail, but it's really supported by different DFIs, European DFIs, putting funds into the fund, and then it's meant to provide actual capital to microfinance institutions, banks, different players operating in the affordable housing market. So this is such a structure that is going to be a fund which is specifically designed to be catalytic in terms of providing capital into the affordable housing market. So there are such initiatives, and really the microbuild promoted by Habitat, sponsored by Habitat, is the best example in the affordable housing market. And it would really warrant a case study on its own to do it justice. It's going to be the coverage is going to be quite similar to microbuild 1, which is going to cover Latin America, Africa, and Asia. So very much it is for the developing for the developing market, emerging markets. So West Africa, I can say with confidence, definitely would be covered.
Any other reflections on any of those 4, 5? What you envision going forward, because I think that is more important going forward. How can microfinance be implemented in small island countries with the limited financial resources? Yes, I think there is a question that how can housing microfinance be implemented in low-income and small island countries with limited financial resources? This is the most ideal product for that segment, and that is a complete fit. So it's not that housing microfinance is for huge economies. No, it is for, because as I indicated, it's an average of $600, $1,000. So these are not humongous sums of money. So it's ideal for that, and that is what is ideally planned for people who have low income and they're doing their homes incrementally. So it's quite ideal. It's not limited to small economies.
And I would also add, the housing microfinance as a product would not exist in isolation. It will fit in the financial ecosystem that exists in, say, the small island country in itself. Does it have a microfinance sector? Or is it only formalized banking? So then housing microfinance would exist in the existing financial ecosystem. If there's a viable microfinance sector, then housing microfinance just becomes another service, so another product. And it's more around the design and ensuring that it really fits the ecosystem, the climate context. That's why then informed product design comes in. But it's very much or operate in the economic and financial ecosystem of the given country, or even if it's a small island. So at this point, Belinda, I think we could take guidance from you. Otherwise, from our end, the intention is we're going to have a reflection on the webinar, the series, the questions that have arisen, and try to see what it is that then we can take to the AUHF conference in November in Lusaka, where we intend to have a form of wrap-up session. So if there are any gaps that are coming out of this, we'll definitely see what we can bring to the AUHF conference when we're going to have a session on housing microfinance. And still, if there are some gaps that you feel are remaining, or topics that you feel you'd want to explore later, or which you'd want us to have more of a deep dive into, please do reach out to the AUHF, and we can see what it is that we can take forward to the conference, or look at any other avenues, or if might maybe be a written note just to complement any areas of strong interest that might be arising out of this webinar series. Otherwise, from my side, it's been a pleasure to get to engage with with you over the 3 months, and looking forward to other avenues where we can take some collaboration forward with some of you. Over to you, Stephen.
Okay, also I take this opportunity, I think, to thank you all for being there for the last 3 months, and we look forward to taking this housing microfinance a notch higher. And this is what people need, and this is what we should develop, and not to be apologetic about, because it's a practice, is what our people are doing to be able to put a roof over their head. Thank you, and I look forward to more collaboration. And we'll be more than glad to answer all your queries. You have our contact details. Please reach out to us. Thank you.
Thanks, Stephen and Bezant. Really helpful to have taken us through the session and the discussion. There's so much to still unpack. We hope the audience can still send in their questions in case any were not addressed, in case the topics we didn't touch on through the three-part series. We're very happy to get that feedback, and we can see how to accommodate that. And also, if there are interesting case studies that we could feature, they're happy to get that input as well from the audience. Please do reach out to us through Tandiwe. Her email is tandiwe@housingfinanceafrica.org. I'll just drop it in the chat. Please do share your comments, your feedback, and look out for more topics. This has been a housing microfinance. More topics are coming up under the AUHF Academy. Please do look out for that. Really happy to have had you on the call today. Thank you, everyone. Enjoy the rest of your day, and please be in touch. Thank you.